Good morning. We're Rishi Avichal and Nick DeJulia, and today we're presenting our investment analysis of Berkshire Hathaway Class B shares. Our recommendation is buy to hold with a 2031 target price of $880.
As of February 13th, Berkshire trades at $497.55 per share, with a market cap of $1.073 trillion and $381 billion in cash. Our intrinsic value estimate is $501, which essentially reflects fair value today. In early 2026, high multiple tech and AI stocks experienced sharp corrections, creating uncertainty and prompting capital to rotate towards businesses with more predictable, cash-generating operations. Berkshire's combination of insurance float, regulated utilities, and diversified industrial subsidiaries provide precisely that type of structural resilience. Even under conservative assumptions, our model reaches a 2031 price target of $880 per share, implying roughly 12% annualized return. In a market where many high-growth options carry elevated risk, Berkshire represents a disciplined, durable approach to long-term compounding.
Berkshire operates simultaneously as a conglomerate, an insurance company, and an investment fund, a structure no competitor truly replicates. Its first core engine is the insurance float. Berkshire collects premiums upfront and reinvests before claims are paid. That float stands at $176 billion today, and as long as underwriting is profitable, it carries negative cost. The second engine is BNSF Railway, which operates the Southern Transcon, the most efficient freight corridor between the West Coast and the Midwest, on infrastructure that is effectively irreplaceable. The third is Berkshire Hathaway Energy, a fully owned utility with a $106.8 billion regulated rate base, serving over 12 million customers across 11 markets. Combined with 20 plus subsidiaries in manufacturing, retail, and services, Berkshire generates over $370 billion in trailing revenue.
The global financial services market is valued at $38.6 trillion in 2025, projected to reach $51 trillion by 2030 at a 7.3% compounded annual growth rate. Berkshire deploys $1.226 trillion in capital, more than Allianz, Prudential, or MetLife. But the difference is not size, it is composition. Competitors deploy predominantly policyholder-funded capital, which can force liquidation during downturns. Berkshire deploys majority-owned capital, giving it full control over long-term strategy and eliminating forced selling during economic transition.
BHE generates $20 billion in revenue from a $106.8 billion regulated rate base, predictable government-backed returns. BNSF produced $17.45 billion in 9-month revenue with a 65.6% operating ratio, competitive among Class 1 railroads in the legal ballistic market. On insurance, Berkshire generated $90.95 billion in premiums, a combined ratio of 88.8%, and a net profit margin of 19.5%. A combined ratio below 100 means underwriting is profitable, so the float is not just cost-free capital, it earns money on its own.
Berkshire has outperformed the S&P 500 40 out of the last 60 years, averaging 19.9% annually versus the index's 10.4%. Most importantly, it outperformed in 19 out of the last 20 years when the S&P was negative. Natural monopolies in rail and energy, cost-free insurance capital, and $381 billion in liquidity creates a business designed to generate billions regardless of macroeconomic conditions.
Through Porter's five forces, new entrants are a very low threat due to regulatory barriers and capital requirements. Supplier power is low, buyer power is low to moderate, substitutes are a moderate risk, and rivalry is high in the insurance sector, specifically Geico versus Progressive. Berkshire's moat comes down to cost-free capital, irreplaceable infrastructure, regulated monopolies, and an unmatched liquidity. A combination no competitor can replicate.
Heading into 2026, Berkshire made three key moves. First, it cut its Apple stake by over 70%, converting a concentrated tech position into liquidity. Second, it acquired OxyChem for $9.7 billion, a top 3 U.S. chemical manufacturer with regulated utility characteristics and stable to high demand. Third, under incoming CEO Greg Abel, it increased its investment in Japanese trading houses, diversifying geographically and reducing U.S.-China exposure. Each move reinforces stability while preserving upside.
Our hybrid sum of the parts model produces a current fair value of $501 per share, closely aligned with today's price. The 2031 projection is $880, roughly 12% annualized returns on total equity approaching $1.9 trillion, built on deliberately conservative assumptions throughout.
A standard DCF doesn't work for Berkshire. With industrial businesses, insurance, a massive equity portfolio, and $381 billion in cash, each segment needs its own valuation lens, which is why we use the hybrid sum of the parts model. Operating businesses were valued on a 2-year normalized EBIT and EVT to EBIT multiples. 2 years specifically to exclude the COVID tail, which would have distorted the numbers. Insurance underwriting used a PE multiple on normalized earnings. The float was valued at 90% usability haircut, conservative given Berkshire's record of profitable underwriting. The equity portfolio was marked to market net of deferred taxes, and cash was held completely flat, almost certainly understating reality. The one input that stands out is the roughly 32 times multiple on Berkshire Hathaway Energy. That requires explanation. AI data centers are the fastest growing electricity load in history. Major tech firms are expected to invest $700 billion in AI infrastructure in 2026. BHE, a regulated utility, earns a government guaranteed rate on every dollar it puts into new capacity. So it captures the demand surge with a protected income floor. High growth and regulatory certainty together justify a premium multiple. We also did not apply the conglomerate discount. Berkshire has centralized capital allocation, where float funds acquisitions, cash funds, equity investments, and internal reallocation avoids dividend taxes and unnecessary transaction costs, eliminates the inefficiencies that typically justifies one. Conservative everywhere else, the model still reaches $880 by 2031.
Here you can see the full segment-by-segment breakdown of our hybrid sum-of-the-parts model based on the latest 2024 annual report. Starting with the operating businesses, BNSF has a 2-year normalized EBIT of $7.7 billion, growing at a 10-year average CAGR of 3.6%, and using a 10.1 EV to EBIT multiple, yielding a current equity value of $56.5 billion, growing to $74.8 billion by 2031. BHE shows a 2-year normalized EBIT of $4 billion, with a 13.9% CAGR and a 32.2 EV to EBIT multiple. That elevated multiple is justified by the AI-driven power demand, producing a current equity value of $74.5 billion, reaching $246.5 billion by 2031. The manufacturing, services, and retail segment has a normalized EBIT of $18.6 billion at a 9.8 EV to EBIT multiple, for a current value of $157.7 billion, growing to $380.1 billion by 2031. On the insurance side, normalized underwriting earnings of $7.2 billion at a 16.3x PE multiple give an underwriting value of $117.5 billion. The float currently stands at $171 billion, growing at a 7.6% annually to $284.8 billion by 2031, with a 90% usability rate applied to be conservative, producing a total insurance value of $271.4 billion today and $461.4 billion in 2031. For the investment portfolio, the net equity value after deferred tax liability is $224.4 billion today, growing to $436.7 billion in 2031. Cash and treasury bills are held flat at $318 billion as a conservative assumption. Netting out the $21 billion in parent level debt, our total equity value is $1.081 trillion today, $501.29 per share versus the current price of $497.24, representing a 0.4 upside. By 2031, total equity value reaches $1.897 trillion, or $879.09 per share, for a 12.07% annualized return. There are two primary investment risks that need to be discussed. First, revenue stagnation. Since 2020, the Mag 7 returned 276.8% versus Berkshire's 121.2%. In tech-driven markets, opportunity cost is real. Second, leadership succession. Greg Abel takes over in 2026, and any drift from Buffett's long-term philosophy introduces execution risk. Overall, we assess the risk profile as low given Berkshire's diversification and structural advantages.
Berkshire ranks 53rd globally in sustainability, has pledged $34 billion towards renewables, and has donated over $62 billion in its history. On AI, Geico optimizes underwriting and fraud detection, BHE improves grid stability and renewable integration, and BNSF uses it for predictive maintenance and logistics. Berkshire is not chasing AI hype. It is embedding AI into its stable, regulated operations to improve efficiency and margins.
At $497, Berkshire offers $1.226 trillion in capital deployed, $381 billion in liquidity, $186 billion in cost-free float, and natural monopolies in rail and energy. This is not a speculative growth story. It is disciplined, asymmetric compounding potential with fortress-like stability. Our recommendation is buy to hold with a target price of $880 by 2031, approximately 12% annualized return. Thank you.